What's up YouTube, it's Rhett back at it again with another video. A couple weeks ago I got my hands on the BlockFi rewards credit card, and so over the next couple months I'm going to be making some more videos about BlockFi and Gemini Earn and some other CeFi products. With that being said, I think a lot of people out there still don't really understand the risks of investing in some of these CeFi platforms. So today I'm going to be presenting and simplifying Kraken's latest white paper, which is titled Deconstructing CeFi. I came across the white paper a few days ago when it was published. I read through it. There's a ton of really great information in there, so I'm going to be leaving the link to the full report down in the description. So definitely check that out after you're done watching this video. There's a lot of information in there, and I'm not going to be able to get to all of it in the scope of this video, just to keep things short and digestible for you guys. So if I do my job right, by the end of this video, you should have a better idea about what a CeFi product is, what the difference is between CeFi and DeFi, what all the different risks are that come with investing in a CeFi platform, and then finally, how should you be thinking about the interest rates that they're able to provide to you, and how should you think about and quantify the different risks that we cover later on in the video. Go down below, smash the like button for financial education, and let's jump into it. So first, what is CeFi? CeFi stands for centralized finance, and it's basically just the umbrella term that's used to, first of all, categorize legacy financial institutions like Charles Schwab and Fidelity, but also now to categorize some new crypto CeFi solutions like BlockFi or Gemini Earn or the Celsius network. All of these are examples of private companies that you're investing money in, and then they're earning you some yield one way or another. A lot of people just see the really high interest rates and they're like, oh, this is great. I'm gonna, take advantage of these huge interest rates. It's way better than what I'm getting in my savings account. But I haven't really found any videos on YouTube of people doing deep dives into what the different risks of these platforms are, how these platforms work, and what they're doing to make their money. And so luckily for us, Kraken has deconstructed this in their latest white paper, and they have a really great graphic that shows you how these companies are able to make money. And basically they're operating just like a normal bank. The CeFi platform offers some interest rate to depositors. Let's say, for example, that interest rate here is 5%. You, the depositor, deposits fiat or crypto into the platform. The platform receives your deposit and then goes ahead and lends that out to some institutional trading partner who pays a higher rate to the platform, maybe call it 8%. So the platform then pays you out 5% of that 8% and takes 3% for themselves. So at this point, a lot of people ask, well, why would a trading firm want to be paying BlockFi or any of these other companies 8% just to borrow money? And there are a lot of reasons for this, but some of the really well-known reasons revolve around some of these popular arbitrage trades that have popped up in the Bitcoin market. For example, for a long time, there was this really popular Bitcoin contango trade, and contango basically just means that the futures market, or the price that someone might pay in the next month or 2 months or 3 months for Bitcoin, was continuously increasing. So if it was 30,000 this month, maybe it was 32 next month, and 35 the month after, and 38 the month after. And so when that futures market is in contango, trading institutions can buy one Bitcoin at $30,000 and then sell one Bitcoin a month from now for $33,000 and pick up that market spread. The contango spreads weren't ever really that high. That's like a 10% spread, and that would be really, really big, but they were between like 1% and 3%, which over an entire year is between 12 and 36% APY, which makes it a no-brainer for them to take out a loan at BlockFi at 8% interest. And so that trading company is happy because they're making, 36 minus 8% APY. BlockFi is happy because they're able to pass interest rate savings along to you, and they're able to skim some interest rate off the top for themselves. And as some of these trading strategies start to die off or not become popular anymore, BlockFi in response has to lower their interest rates, which is something that they've done quite a bit over the last few months. So that's sort of a high-level example of how do these CeFi platforms work, and why would a trading institution want to partner with a CeFi platform to give them those really high interest rates that they can pass along to you. For the next part of the video, let's compare CeFi to DeFi and see what some of the differences are. Luckily, Kraken has given us some really easy to understand tables comparing CeFi applications to DeFi applications, so let's take a look at that here. So typically, CeFi is managed and secured by some entity, in this case maybe BlockFi or Gemini Earn. Typically, these CeFi platforms will offer lending and trading and borrowing, and also act as on-ramps into crypto from fiat, so they'll take your fiat and convert it to crypto. They come with dedicated customer support teams because they are private companies, and they require KYC AML verifications because they are operating as private companies in a lot of these different jurisdictions around the world. And so when you compare this to DeFi applications are managed and secured by the protocols that are underlying them, most typically applications built on top of Ethereum. DeFi typically offers those same services, but instead of being a fiat on-ramp, it's actually a crypto on-ramp. So you're taking some crypto like Ethereum or some ERC20 derivative, putting it into your DeFi application, and then you're able to trade it around to get different ERC20 derivatives, all usually on top of Ethereum or maybe on top of BNB or some other sort of smart contract platform. DeFi doesn't have any centralized support system because it is just a protocol. You might be able to find some sort of Discord or some sort of server where people can help you out, but there is no dedicated centralized customer support. And then there is no KYC AML that you have to go through. DeFi is open to everyone, at least as it stands today. There have been some questions around how these products will be regulated in the future. Next, if we take a look at some of the different interest rates that you can get on popular CeFi and popular DeFi platforms, you can see in this one cherry-picked example from Kraken that these CeFi yields are a lot higher than these DeFi yields, and that both CeFi and DeFi yields are orders of magnitude higher than US Treasuries and foreign treasuries and US savings accounts and foreign savings accounts. These traditional instruments of treasuries and savings accounts are usually seen as the risk-free rate, and that's because any money that you do put into a savings account is insured up to a certain amount by the FDIC. However, some people might argue that there's a fair amount of inflation risk associated with keeping a lot of cash in US Treasuries or foreign treasuries or US savings accounts or foreign savings accounts. And that's just because we've seen over time all fiat money has been debased drastically over time. And so cash isn't really a great store of value asset. If you guys want to learn more about central banks, it's sort of outside the scope of this video, but let me know in the comments if you are interested in learning more about how central banks have driven interest rates to basically zero all over the world. I think it's a really interesting topic, so go ahead and let me know if you're interested in that and I'll make a video on it. So if we get back to those CeFi and DeFi rates that we were talking about earlier, this Kraken table has the CeFi and DeFi rates for Ethereum and DAI, which are some pretty big tokens in the yield space. If we pick some more obscure tokens, some of the DeFi yields might be a lot higher. There are totally ridiculous DeFi yield farming strategies that yield like 1,000% APY, but there's also a ton of risk that comes with putting your money into contracts like that. And really the biggest risk of all is that you could get rug pulled like billionaire goofball Mark Cuban did recently. And this is something that billionaire goofball Mark Cuban should have seen when he put his money into that sweet 1,000% APY yield farming strategy. Because as the Kraken paper points out, interest rates are made up of the foundational interest rate or the risk-free rate plus the risk premium. And this risk premium in CeFi is basically the default risk that the platform takes when they reallocate your money to someone else. If that entity that they lend all that money to loses the money and is unable to pay it back, BlockFi or whatever this CeFi platform is going to have a hard time giving you the interest that they claim that you deserve for that month, or maybe even keeping your base deposit in your account, obviously depending on how bad the losses are. The risk-free rate, or that savings account or treasuries rate that we talked about earlier, in fiat these days is a lot less than 1%, but just for the sake of the math and the rest of this video, let's pretend that the risk-free rate is 1%, just to make the math easy. In this scenario, we can estimate that DeFi degenerate Mark Cuban was accepting a 999% risk premium when he YOLO'd all of his money into that galaxy brain yield farming strategy. Play stupid games, win stupid prizes. In reality, when we think about that 999% risk premium that Mark Cuban was theoretically accepting, we should take into account all of the risks of DeFi, not just the default risk. And so when it comes to CeFi, in this paper, Kraken breaks up that risk premium into 3 different risks. The first is default risk, the second is custodian risk, and the third is transparency risk. So in this next section of the video, let's go through what all of those risks mean, and then how some of these different CeFi platforms actually mitigate those risks for the customer. So the first risk is default risk, or sometimes it's referred to as counterparty risk. And like we talked about earlier, default risk basically just means what happens if BlockFi lends out your money to some institutional trading partner, and then that institutional trading partner loses all of the money and can't pay back BlockFi plus the 8%. What does BlockFi do? They can't really, they took your money to give it to this other guy. He lost it. What does BlockFi do now? If lots of institutional partners in a situation like this lost money at the same time, maybe in a huge market correction or in a huge bull market run, some sort of extreme event, then BlockFi might be in a really tough place based on how they're managing their risk, right? If they lend out all of the customer money to all of these traders over here and all the traders lose the money at the same time, BlockFi could be in a situation where they don't have the money to cover the deposits of those retail customers like you and me. To date, however, over the last 4 years since BlockFi has been in business, they've been through some huge highs and some huge lows of the crypto market, and they've never lost any of the depositors' money. And this includes that huge one-day crash that we had back in March 2020 at the beginning of the pandemic. And if you talk to executives at BlockFi, I think that they would attribute their success to their risk management strategy and then their policy around creating over-collateralized loans. An over-collateralized loan basically means that if you want an $1,000 loan from BlockFi, you have to actually deposit more than $1,000 of collateral to get that loan. So in the institutional example, maybe this institution wants to borrow $15,000 from BlockFi, so they deposit one $30,000 Bitcoin, they get their $15,000 loan, and then they can go play with that and do whatever they want. And then at the end of the day, even if Bitcoin drops by 50%, BlockFi can still liquidate that one Bitcoin and no one has lost any money. This situation where you have a $15,000 loan collateralized by something that's worth $30,000 in fancy finance language is called a 50% loan to value ratio. So generally, by issuing only over collateralized loans, these CeFi platforms can totally eliminate their default risk, or at least make it very, very, very small. Because worst case scenario, they can always liquidate the collateral and everyone breaks even. Which brings us to a quote by the great Yogi Berra. In theory, there is no difference between theory and practice. In practice, there is. And basically what that quote means is that theoretically, on paper, none of these platforms should ever lose money. But in real life, some of them do. And that brings us to the second risk that we're going to talk about today, which is custodial risk. And custodial risk basically comes down to, at the end of the day, you are trusting BlockFi or Celsius Network or Gemini Earn or whatever platform you're using to actually manage the money that you give them and to actually stick by the things that they say that they're doing with your money. Okay, they have this great risk management strategy where they say every loan is over collateralized, but in reality, is every loan over collateralized? And do they liquidate those loans when the value gets to the break-even price? On top of that, are they creating a safe platform where they've custodied your assets in a secure fashion? Do they have any sort of insurance policy in case the people that they're custodying the Bitcoin with lose the Bitcoin or lose the US dollar stablecoins or any of these other crypto assets? Have they implemented any of the safety standards that are common within the industry? And are they more safety focused or are they more focused on providing you a high interest rate? All sorts of questions like this come up when you think about custodial risk. And then a way that some CeFi custodians like Ledin and Unchained Capital have actually mitigated some of the custodial risk is by implementing something called proof of reserves, which is basically where they're holding your Bitcoin or whatever crypto you deposit with them in a public address on the blockchain that you can monitor at all times to make sure that they're not rehypothecating that Bitcoin to someone else and then theoretically losing that money. This transparency of proof of reserves is huge from a user confidence perspective, and hopefully every company in the space can get around to implementing something like this in the future. And so speaking of transparency, the very final risk that we're going to talk about today is transparency risk. Ultimately, CeFi is very new, and while these companies can claim to have all these practices and stopgaps in place, it's a difference again between are you implementing the strategy or are you just saying that you have the strategy and you're not actually implementing it. Kraken points to a very public blow up of a popular crypto lending platform that was called Cred back in 2020, where Cred filed for bankruptcy after losing all of their users' funds. And again, before filing for bankruptcy, Cred claimed to only lend out user deposits on a fully collateralized basis. However, this was obviously found to not be the case after they filed for bankruptcy. And this is a situation where you'd actually expect CeFi to have a lot less transparency risk than DeFi. Because obviously in DeFi, some of these protocols and hacks happen and are executed by fully anonymous people. Whereas over in CeFi, all of these executives are actually legally liable for the things that they say. And so there's incentive for them to not outright lie to customers. Whereas when Mark Cuban Banana Man gets rug pulled over in DeFi, he doesn't really have any recourse. I actually think that BlockFi has excelled when it comes to minimizing transparency risk. Their CEO and head risk manager have had very public, long-form conversations on multiple large podcasts and have had very consistent and understandable stories. And I think it's actually really important for customers to understand what they're putting their money into before they go ahead and put their money into something. And so down in the description, I'll leave links to a couple of those podcasts if you are wondering how does BlockFi work and how are these executives managing risk and managing the platform. You can definitely go check out those podcasts and learn more than you're going to be able to learn in this video and hear it directly from the mouths of the people who are executing these risk strategies on a day-to-day basis. So after talking through all of those risks, Kraken has taken the math that they've done on how likely those risks are to happen and basically added up those percentages. And they've come to the figure of all of these risks combined, totaling an overall risk of somewhere between 3 and about 3.5%. Next, they're taking the theoretical yield or the advertised yield from these platforms and subtracting that 3 to 3.5% that they have calculated as sort of like the on top overhead risk. to calculate a net yield, which Kraken is using to sort of determine, all right, are these platforms actually worth investing in? It's important to see in this chart, they've calculated ETH's currency risk as around 3%, and they've basically come to that number from ETH's inflation rate, and they arrive at an overall net yield of about negative 1.5% from using these platforms, assuming that 6% ETH interest rate, on top of the major assumptions that they've made when they calculated this risk premium number in the first place. And again, those risk premium numbers that Kraken came up with are very, very rough calculations. Even Kraken says that's not the real risk rate. This is just example data that they came up with. And so I highly suggest that if you want to come up with your own sort of mental model of how to model these risks, that you go through this exercise that they went through basically, put your own numbers to it and see if you think that it's worth it or not based on the math that you do yourself. Hopefully this video wasn't too long or too confusing, and hopefully you guys learned something. Go down below if you did learn something and like the video so that YouTube shares it with other people who are hopefully able to use this video and learn a little bit more about what the risks are to investing in some of these CeFi platforms like BlockFi. I'm going to be making more videos over the next couple months about some of these CeFi platforms like BlockFi and like Gemini Earn, and I thought that it would be really important to get this video out there first so that people could understand, okay, what are actually the risks of investing in a platform like this? I think transparency is super important, and so I didn't want to be talking about these platforms and making it seem like there is no risk, because there absolutely is a risk associated with these platforms. And I think it's important that as more and more people come into this CeFi ecosystem, that they understand those risks before they make any investments into the space. If you do appreciate the detail of some of these deeper dives into the crypto ecosystem, definitely let me know down in the comments. And then if you did have any questions that came up from this video, if I didn't thoroughly explain something enough for you, or if anything I said was confusing, feel free to leave those questions in the comments as well. I do still respond to all the comments. And if I haven't completely discouraged you from using CeFi platforms like BlockFi at this point, and you are actually still interested in the higher interest rates or in the credit card that they just launched, definitely go check out the link in the description. I'll have both the credit card sign up link and a link to just open an account with BlockFi. So definitely check out those links down in the description if you are interested, and then come back here for new videos every Monday at 10 a.m. Eastern. I love you all. Goodbye.